Hello, fellow investors and finance enthusiasts. It's Iggy here from the Investing Iguana, your guide in the jungle of investment opportunities. In today's exciting video titled Uncover Singapore's Undervalued Stocks, Top Picks for 2024, we're going on a treasure hunt on the Singapore Exchange. This video was created as a response to a request by one of our regular viewers who wanted to find out some good undervalued stocks for 2024. Hence, I'll be revealing to you 5 undervalued stocks that are hidden gems in our market. These picks are not just any ordinary stocks, they're undervalued blue chips with immense potential waiting to be tapped in 2024. Whether you're a seasoned investor or new to the stock market, this video is packed with insights that could help shape your investment strategy for the year ahead. So, stay tuned as we dive deep into each of these stocks and uncover why they might just be your best bets in the coming year. In the vast world of stock trading, where there are 646 stocks listed for trading, our focus is on the very best of the best, the stocks that are part of the Straits Times Index, STI. The STI is a market index that represents the performance of the top 30 companies listed on the Singapore Exchange. These are the stocks that are often referred to as the crème de la crème due to their significant impact on the market. To identify these top-performing stocks, we've done some serious number crunching. We've used the SGX Stock Screener, a tool that allows us to filter stocks based on various financial metrics and indicators. This rigorous process helps us sift through the hundreds of listed stocks to find the ones that truly stand out. But we're not just looking for any stocks. We're on the hunt for hidden gems, stocks that are undervalued compared to their actual worth. One way to find these is by looking at the price-to-book, PB, ratio. The PB ratio is a financial ratio used by investors to compare a company's market price to its book value, or net asset value. Here's where it gets interesting. We're specifically looking for stocks with a PB ratio of less than 1. This means these stocks are trading for less than their net asset value. In other words, if you were to buy these stocks, you'd be paying less than what the company's assets are actually worth. This could potentially be a great investment opportunity, as the market price of these stocks may eventually rise to reflect their true value. So, we're essentially uncovering potential bargains in the stock market. 1. Seatrium, S51PB 0.99. Seatrium, a company that has emerged from the merger of two industry giants, Sembcorp Marine and Keppel Offshore and AMP Marine, is a name that is worth remembering in the world of offshore and marine, O and AMP, M, sector. This merger has created a new entity that combines the strengths and capabilities of both companies, potentially positioning Seatrium as a significant player in the industry. However, like many companies in the O and AMP, M sector, Seatrium has not been immune to industry downturns. It has announced expected losses for the financial year 2023, reflecting the challenging conditions in the market. Despite these setbacks, what's astonishing is that this underdog is currently trading at a staggering minus 89% off its 5-year high. This means that its current market price is significantly lower than what it was 5 years ago. But don't let these figures fool you. Seatrium has a massive net order book worth 17.8 billion Singapore dollars. The net order book is a key indicator of a company's potential future earnings, as it represents the value of orders that the company has received but has not yet fulfilled. This suggests that despite its current low trading price, Seatrium has a substantial amount of work lined up, which could translate into significant revenue in the future. In the cyclical dance of the O and AMP, M sector, where industry conditions ebb and flow, Seatrium is a wildcard. It's a company that, despite facing current challenges, has the potential to bounce back when the industry conditions improve. So, while it may be down now, don't count it out just yet. Seatrium might just be waiting for its moment to shine in the O and AMP, M sector. 2. City Developments, C09PB 0.69. City Developments Limited, CDL, is a titan in the real estate industry with a presence that spans across the globe. Its portfolio is as diverse as it is impressive, ranging from the trendy M Social brand to the luxurious Millennium Hotel brands. This wide-ranging portfolio showcases CDL's ability to cater to a variety of market segments, from the budget-conscious to the high-end luxury seekers. In the first half of 2023, 1H23, CDL experienced an impressive 80% spike in revenue. This substantial increase is a testament to the company's strong business performance and strategic decision-making. Furthermore, CDL has ambitious developments on the horizon, indicating its commitment to growth and expansion. Interestingly, CDL's current price-to-book (PB) ratio suggests that it's a steal. The PB ratio is a financial metric that investors use to compare a company's market price to its book value. A lower PB ratio could indicate that the stock is undervalued, suggesting that investors could potentially buy the stock at a bargain price. However, it's important to note that CDL's net gearing is on the rise, touching 57%. Net gearing is a measure of a company's financial leverage, calculated by comparing its net debt to its equity. A higher net gearing ratio could indicate a higher risk associated with the company's debt level. Therefore, while CDL's low PB ratio and revenue growth are attractive, the increasing net gearing is a factor that potential investors should watch out for. It's a reminder that while there are potential rewards, investing also comes with risks. As always, thorough research and careful consideration are key when making investment decisions. 3. UOL, U14 PB 0.5. The journey of UOL, a renowned real estate company, has been quite a ride, much like a roller coaster. It hasn't always been a bed of roses, as the company has seen a decline in its revenue, profits, and earnings per share, EPS. This downturn is largely attributed to its property development arm, which has been facing challenges that have impacted its financial performance. However, despite these hurdles, there are aspects of UOL that make it a potential contender for a comeback. One such aspect is its dividend yield, which stands at 2.4%. The dividend yield is a financial ratio that shows how much a company returns to its shareholders in the form of dividends. A higher dividend yield can be attractive to investors as it provides them with a regular income stream in addition to any potential capital gains. Another promising sign is UOL's historically lower price-to-book (PB) ratio. The PB ratio is a tool used by investors to gauge if a stock is over or undervalued by comparing the company's market price to its book value. A lower PB ratio could indicate that the stock is undervalued, suggesting that it could be a good buy. So, while UOL's current situation might seem challenging, these factors suggest that it could potentially bounce back. With its attractive dividend yield and lower PB ratio, UOL might just be the comeback kid that investors are waiting for. However, as with all investments, potential investors should conduct thorough research and consider all factors before making a decision. After all, the stock market is a complex entity, and while the potential for gains is significant, so too is the risk. 4. Jardine Matheson Holdings, J36PB 0.41. Jardine Matheson is not merely a company, it's a vast conglomerate empire with a diverse range of operations. Its business interests span across various sectors, from retail to construction, demonstrating its extensive reach and versatility. Jardine Matheson, often referred to as JDM, has a significant presence in numerous industries, making it a key player in the global market. One of the remarkable aspects of Jardine Matheson is its substantial stakes in other companies. It holds a 75% stake in Jardine Cycle and AMP, Carriage, Jardine C and AMP, C, and a 52% stake in Hong Kong Land. These investments further extend its influence and diversify its portfolio, adding to its robustness. Despite the complexity of its operations, Jardine Matheson has managed to maintain a continuous dividend payout. This is an attractive feature for investors as it provides a steady income stream. Moreover, its current price-to-book (PB) ratio indicates a potential undervaluation. The PB ratio is a financial metric that compares a company's market price to its book value. A lower PB ratio could suggest that the company's stock is undervalued, making it an attractive investment opportunity. However, it's important to remember that Jardine Matheson operates in a cyclical business environment. This means that its performance can fluctuate based on economic cycles. Therefore, timing is crucial when investing in such businesses. Investors need to carefully consider the economic cycle and market conditions when making investment decisions. So, while Jardine Matheson presents potential opportunities, it's essential to approach it with a comprehensive understanding of its operations and the market dynamics. 5. Mapletree Pan Asia Commercial Trust, N2IUPB 0.88. Mapletree Pan Asia Commercial Trust, often referred to as Impact, has undergone a significant transformation post-merger. It now boasts an impressive portfolio that spans across 5 key Asian markets. This geographical diversity not only enhances its market presence, but also provides it with a broad base of assets and revenue streams. Despite facing challenges in North Asia, Impact has taken strategic steps to strengthen its defenses. One such step is the increase in its fixed-rate debt to 79.9%. Fixed-rate debt refers to loans or borrowings that have a fixed interest rate, providing predictability in terms of interest payments. This move can be seen as a protective measure against potential interest rate fluctuations, thereby providing financial stability to the company. In addition to its strategic financial management, Impact also offers an attractive dividend yield of 5.8%. The dividend yield is a financial ratio that indicates how much a company pays out in dividends each year relative to its share price. A higher dividend yield can be appealing to investors as it provides them with a steady income stream. Furthermore, Impact's price-to-book (PB) ratio is lower than its historical average. The PB ratio is a valuation ratio that is used by investors to compare a company's current market price to its book value. A lower PB ratio could suggest that the company's stock is undervalued, indicating a potential investment opportunity. These factors suggest that Impact is more than just a flash in the pan. Despite the challenges it faces, its strategic financial management, attractive dividend yield, and potential undervaluation indicate that it has the potential to deliver value to its investors over the long term. So in a nutshell, what's Iggy's take on these 5 stocks in 2024? Here's my quick final analysis. Seatrium, S51. Starting with Seatrium, a promising player in the O and AMP sector, we see a stock trading at nearly 89% below its 5-year high. Given its significant net order book of 17.8 billion Singapore dollars, there's potential for a strong rebound. However, investors should tread cautiously. The company's expected losses for FY 2023 signal challenges ahead. The key for Seatrium will be its ability to capitalize on the cyclical nature of the O and AMP industry. If the sector rebounds, Seatrium could see significant gains, but the timing of this upturn remains uncertain. City Developments, C09CDL's impressive 80% revenue increase in 1H23 positions it well for growth in 2024. However, the rise in net gearing to 57% is a red flag. Investors should monitor its debt levels closely. The real estate market's resilience in the face of economic headwinds will be crucial. If CDL can successfully manage its debt and leverage its diverse portfolio, it could outperform market expectations. U14's current PB of 0.5 suggests significant undervaluation. The company has experienced a downturn in its property development segment, impacting its overall performance. For 2024, UOL's recovery will hinge on its ability to revitalize this segment and capitalize on any upswing in the real estate market. With a stable dividend yield, UOL could be a solid pick for value investors. Jardine Matheson Holdings, J36. Jardine Matheson's vast conglomerate structure makes it a complex but intriguing investment. Trading at a PB of 0.41, it appears significantly undervalued. However, the cyclical nature of its businesses means that its performance in 2024 will largely depend on the broader economic environment. Investors should watch for signs of economic recovery, which could greatly benefit Jardine Matheson's diverse operations. Mapletree Pan-Asia Commercial Trust, N2IU. Finally, Impact, with its extensive portfolio across Asia, faces a mixed outlook. The trust has shown resilience in its Singapore portfolio, but its North Asia holdings may continue to drag performance. Impact's increase in fixed-rate debt to 79.9% is a strategic move to mitigate interest rate risks. For 2024, investors should watch for any signs of recovery in the North Asia markets, which could significantly boost Impact's overall performance. And there you have it, the top 5 undervalued stocks in Singapore that you should keep an eye on for 2024. We've journeyed through each of these unique investment opportunities, uncovering their potential and understanding why they stand out in the current market. Remember, investing wisely is all about spotting the right opportunities at the right time. If you found this video helpful and enjoyed our stock market deep dive, please hit that like button and share it with your fellow investors. Don't forget to subscribe to Investing Iguana for more insightful content like this. We're here to help you navigate the complex world of finance with ease and confidence. Thanks for watching, and until next time, keep your investments smart and your portfolio strong.